Welcome to the SafeSimpleSound podcast, where our approach to financial planning creates both and solutions for the contradictions families face. I'm speaking with you today, drawing from our team's chartered financial consultant background and our S3 framework development. Today, we are exploring a source of tension that almost every family encounters at some point in their financial journey. It's a common frustration, often voiced in the quiet moments after a claim is denied or a policy is reviewed. It's that feeling when you pay premiums for years, diligently doing the right thing, only to find that a specific loss is excluded from your coverage. The question naturally arises, why can't I just insure everything to be safe? It feels like a contradiction, doesn't it? On one hand, you want total safety. That's the safe in our SafeSimpleSound framework. You want to wrap your financial life in bubble wrap. But on the other hand, the insurance company insists on strict exclusions that can feel unsafe, or at the very least, confusing. In today's episode, we're exploring the core challenge of insurability. We are discussing this because we recently wrote about this very topic on our blog, highlighting that this isn't a refusal of service by insurance companies. It's actually a requirement of mathematics. Whether you are just starting to build your financial foundation or you are approaching retirement and looking to secure your legacy, this episode will give you what we call S3 confidence. We're going to open the black box of insurance denials to show you the 4 specific rules that make the system work. By the end of this episode, you won't just understand insurance better. You'll have a new lens through which to view risk in your own life. You'll understand why the system works the way it does, moving you from a place of anxiety about exclusions to a place of empowerment about your planning. So let's settle in, let's take a breath, and let's apply some S3 thinking to the architecture of your protection. Let's begin by addressing the elephant in the room. There is a prevalent myth in personal finance, one that we see often in our practice, that if we just pay enough money, we can transfer every risk we face. It's the myth of total coverage. This stems from a very human desire for certainty. We want to know that no matter what happens, whether it's a car accident, a lost heirloom, or just the wear and tear of daily life, someone else will pick up the tab. However, from our SafeSimpleSound perspective, it is vital to understand that insurance is not a catch-all safety net. It is a precise mathematical tool designed for specific types of uncertainty. If an insurer tried to cover everything, imagine for a moment a policy that covered the wear on your tires, the sadness of a lost business deal, the scratch on your kitchen table, and catastrophic health events all in one. The system would essentially collapse. Why? Because premiums would have to skyrocket to infinity to cover the certainty of those losses, or the company would go bankrupt, leaving no one protected. This brings us to our first principle for today: integration over abandonment. We don't want to abandon the idea of safety, but we must integrate the reality of mathematics. To be truly safe, meaning to ensure the insurance company is still there with a check in hand 20 years from now when you really need them, the system must limit what it accepts. Drawing from our CFC background at SafeSimpleSound, we look at the foundation of insurance not as a series of no's, but as a structure built on 4 requisites. Today, we are going to focus deeply on the 2 most critical ones mentioned in our recent writing: the law of large numbers and the requirement of accident. Let's break down the first requisite. In the industry, this is formally known as a large number of homogeneous exposure units. Now that sounds complex, but let's make it simple. This essentially means safety in numbers combined with apples-to-apples comparisons. Insurance works by pooling the risk of many people to pay for the losses of a few. To set a fair premium that you can actually afford, an insurer needs to predict how many losses will happen in a given year. Here's the key. They cannot predict your specific house fire. It is impossible to know if your specific home will suffer a tragedy this year. However, they can predict, with remarkable accuracy, that out of 100,000 similar suburban homes, roughly 100 will burn down this year. This prediction is only possible if the units, the houses, are similar or homogeneous. This is why, in our practice, we often explain that it is easy and relatively cheap to insure a Toyota Camry. Why? Because there are millions of data points. We know exactly how a Camry crashes, how much the parts cost, and how often they are stolen. Conversely, it is incredibly difficult and expensive to insure a prototype satellite or a one-of-a-kind antique violin. Without those homogeneous or similar units, the math fails. The foundation cracks. There isn't a pool of risk to share. So when you see an exclusion for a unique item or a high premium for a specialized risk, it's not because the insurer is being difficult. It's because the requirement of large numbers hasn't been met. Now let's move to the second and perhaps most critical requisite. The loss must be accidental and unintentional. In legal and industry terms, we call this the fortuitous standard. This concept aligns perfectly with our sound principles of responsibility. Insurance is designed to protect against fate, not choice. Think about it this way. If you could intentionally burn down your house to collect a check because you wanted to move, that isn't a risk. That is a choice. If insurance covered intentional acts, the cost would be astronomical because people would utilize insurance as a funding mechanism for their decisions, rather than a safety net for tragedies. Furthermore, and this is a nuance we often discuss in our SafeSimpleSound framework, insurance does not cover inevitable decline. If a loss is inevitable, like a timing belt wearing out on a car or a roof reaching the end of its 30-year lifespan, it ceases to be a risk. It becomes a certainty. You cannot transfer a certainty. From a S3 perspective, using insurance to pay for maintenance is like trying to use a fire extinguisher to water your plants. It's the wrong tool for the job. We use insurance to protect against the unforeseen, not to pay for our own maintenance or bad decisions. When we understand this distinction, we stop viewing a denial for wear and tear as an injustice. Instead, we see it as a reminder of our own responsibility to plan for the inevitable maintenance of our lives, keeping our insurance premiums reserved for the true catastrophes. This distinction between the accidental and the inevitable is what separates financial planning from gambling. Gambling, or speculative risk, creates a new risk in hopes of gain. You put money on the table hoping to win. The outcome is win or lose. Insurance deals with pure risk. It transfers an existing risk to maintain the status quo. The outcome is loss or no loss. We're trying to get back to zero, not get ahead. By respecting these rules, large numbers, and accidental losses, we ensure that the insurance pool remains solvent. We don't want an insurer that says yes to everything. That sounds nice in theory, but in practice, that is an insurer that will be bankrupt in 5 years. We want an insurer that is mathematically sound enough to exist 20, 30, or 40 years from now. That is the definition of safe. To really bring these abstract concepts down to earth, we find it helpful to look at how they play out in a family's life. Let me share a hypothetical scenario that illustrates how these principles might apply. While this story is fictional and created purely for educational purposes, it demonstrates patterns we frequently observe when families attempt to apply SafeSimpleSound thinking to their risk management. Imagine a fictional couple. Let's call them the Millers. The Millers are in their mid-40s, diligent savers, and they pride themselves on being prepared. They have applied the safe and simple pillars to their savings, but they are currently wrestling with the sound pillar regarding their insurance. The Millers have recently purchased a beautiful historic Victorian home. It's a stunning property, full of character. Along with the home, Mr. Miller has finally purchased his dream car, a rare, limited production vintage sports car from the 1950s that he plans to restore. They sit down to review their insurance coverage, expecting to simply bundle everything together for full protection. They want that feeling of total safety. However, they run into two significant roadblocks that leave them feeling frustrated and exposed. First, regarding the home, the insurance inspector notes that the slate roof is original to the house, over 100 years old. It's not leaking yet, but it is clearly at the end of its life. The insurer agrees to cover the house for fire, wind, and hail, but they specifically exclude any damage caused by the wear and tear or deterioration of the roof. Furthermore, they state that if the roof leaks due to age, the interior water damage might not be covered either. The Millers are upset. "We are paying you to protect this house," they say. "Why is the most expensive part of the house excluded?" Second, regarding the car. Mr. Miller struggles to find a standard auto carrier who will touch the vintage sports car. The few that will consider it are asking for premiums that seem astronomically high, or they require an appraisal that costs thousands of dollars. One insurer tells him, "We just don't have the data to price this risk." This hypothetical situation puts the Millers in a state of tension. They feel the system is failing them. Now, while the Millers are fictional, their frustration is very real. Let's look at this through our SafeSimpleSound lens to understand what is actually happening here. Let's look at the roof first. This connects back to the requirement of accident. From the Miller's perspective, a leaking roof feels like a disaster. But from the S3 perspective, a 100-year-old roof failing is not an accident. It is a certainty. It is a maintenance event. If the insurance company agreed to pay for the replacement of every old roof, they wouldn't be insuring against risk. They would be funding home renovations. The premiums for everyone in the pool would have to rise to the cost of a new roof every 20 or 30 years. By excluding wear and tear, the insurer is forcing the Millers to engage in sound financial planning. The replacement of that roof is a predictable capital expense. It belongs in their savings plan, not their insurance policy. The insurance is there for the lightning strike, the accident, not the slow march of time. Now, let's look at the vintage car. This connects back to the law of large numbers. The standard auto insurer usually deals with Hondas, Fords, and Toyotas. They have millions of homogeneous exposure units. They know the math. Mr. Miller's car is unique. It is not homogeneous. There is no safety in numbers for a 1950s limited-run vehicle. If he crashes it, finding parts isn't a standard procedure. It's a treasure hunt. The cost is unpredictable. Because the insurer cannot use the law of large numbers to predict the loss, they have two choices: decline the coverage to keep the pool safe, or charge a premium high enough to account for the massive uncertainty. Through this example, you can see how S3 thinking applies. The Millers aren't being targeted. The insurance company isn't being malicious. They are adhering to the mathematical laws that keep the system solvent. Whether you're facing this exact scenario or something similar, perhaps you're trying to insure a jewelry collection, a home in a flood zone, or even navigating health insurance exclusions, the principle remains the same. The S3 framework helps us step back and ask, is this a risk transfer or is this a maintenance issue? And is this a common risk or a unique one? When the Millers realize this, their mindset shifts. They stop fighting the insurance company and start adjusting their plan. Safe. They accept the exclusion on the roof and immediately start a dedicated capital expenditure savings bucket to self-insure that inevitably. Simple. They seek out a specialty insurer for the car, one that specifically deals with collectors, simplifying the process by finding a pool that matches their risk. They recognize that insurance is for the catastrophic unknown, not the expensive known. This brings them peace. They move from feeling cheated to feeling in control. They understand the architecture of their protection. As we begin to wrap up this episode, let's consolidate what we've learned today through our SafeSimpleSound lens. We started with the frustration of not being able to insure everything. We unpacked the reality that insurance is not a magic wand, but a mathematical tool governed by 4 strict requisites. We specifically looked at 2 of those rules. 1, the law of large numbers, the need for many similar items to create a safe pool of risk. 2, the requirement of accident, the necessity for losses to be fortuitous and unintentional, separating true risk from maintenance and choice. We saw through the hypothetical story of the Millers how these rules play out in real life, protecting the solvency of the system so that when true tragedy strikes, the promise to pay can be kept. This is the essence of confidence. It's knowing that your financial plan isn't built on wishful thinking, but on sound principles. It allows you to look at an exclusion not with fear, but with understanding. So, what is the practical next step for you? If you are listening to this and wondering, okay, but how do I know which of my risks are insurable and which ones I need to handle myself? We have a resource for you. This episode draws from our recent blog post titled, "Why Can't We Insure Everything?" which you can find at SafeSimpleSound.com. Through our S3 approach development, we've created a specific tool called the S3 Insurability Filter, what fits and what falls through. This is a visual guide that maps out the four requisites of insurability. It helps you immediately understand why certain claims might be denied, and more importantly, how to spot uninsurable risks in your own life before they happen. We invite you to go to SafeSimpleSound.com and download that filter. Use it to audit your own risks. Look at your home, your car, your health, and your business. Ask yourself, is this a maintenance issue I should be saving for? Or is this a catastrophic risk I should be transferring? If today's S3 insights resonate with your family's situation, and if you feel that you would benefit from a team that applies this kind of thinking to your entire financial picture, we invite you to explore what financial planning could look like through our Safe, Simple, Sound practice. But either way, whether you engage with our practice or not, you are now equipped with a new capability. You have the knowledge to distinguish between gambling and planning, between maintenance and risk. You understand the why behind the system. Thank you for listening to the Safe, Simple, Sound podcast. We look forward to being with you again soon, helping you navigate the contradictions of finance with clarity, confidence, and wisdom.